The idea of what we do is we trade. We don't. It's not so much that we trade. We invest in the forex market. We invest within currencies, and our focus is long-term strategy. So this isn't to take away from anything that anybody's doing on a short-term basis. So if you're a binary trader, if you are in some home-based business, if you have a job or whatever the case may be, there by no means am I telling anybody to stop doing what you're doing and do this. This is something that you take your safe money. So if you're at the casino and you're playing blackjack and you had $100 and now you're up like $400, you don't want to lose all that. So usually take some money off the table and put it in your pocket. So you take that money that's chipped off the table, and this is what you want to do with it. Because what else are you going to do? Put it in the bank, put it in the stock market, you can do all these different things with it. But I've yet to find something. Now, granted, I'm a little biased because this is my own creation, but I've yet to find something that has this low of risk for the amount of return that we're able to actually achieve out of that. And that's because we're dealing with a $4 trillion a day market. And you'll hear people say, you hear all these traders, they always talk about like they don't ever want to leave money on the table. And that's just it's a fallacy. You're always going to leave money on the table. I mean, there's $4 trillion a day running through this thing. So unless you took home $2 trillion today, you left some money on the table. Our job is just to maximize our performance, to just pull in a healthy rate of return for everybody. In the long run, we speculate. And this is just based on my returns of what I've been doing for quite some time, averaging about a 6% return. However, the world's been getting a little crazier. As a result, over the last quarter here, we've been averaging double-digit returns, 13, 16% this month. We got as high as 4%. It scaled back last week to about 25%. I speculate, unless some of these trades that we currently have, if they don't end this month, will probably hover around that 25, 30% mark, and then next month we'll probably instantly jump right back up to like a 10, 15% gain with some of the existing open trades that we're having. So, any questions so far on that? No. All right. So, the concept of the trade is you do not want to trade any significant amount on any one trade. So a lot of times, I think everybody here, correct me if I'm wrong, everybody here has a binary and a forex short-term style trading background. So the mentality always is high frequency, betting a good chunk of change, and having a high risk of loss. So a lot of times people feel like they get emotional. They get really emotional on every given trade that they have. Whether if they win one, they're very excited, they're super pumped up. They're losing, their emotions run with it. I'm in the business. I'm a financial planner by trade. The biggest thing I do for all my clients, is I look to develop their risk tolerance, and I tell them that if you're putting your money into this fund or that fund or this stock or that bond, if at any given point you feel the need to call me and have a heart attack, you're in the wrong thing. You're absolutely doing the wrong thing. So I spend a lot of time on the psychological development of it. We have tests and charts that we go through to make sure that they're pieced into something right. So most people that are trading forex and most people that are trading binary, psychologically, they just can't handle it. Now, some people are thrill seekers, so they get off on that stuff. But as we know, and this is just statistics, most people just do not profit in those arenas. I think Forex.com, there was a conference that was held like in 2011 or something like that, and this is like the president of the company that he said he would be surprised if 10% of his people, of all the clients, were actually making money on that within Forex. Now Forex is different from binary in the fact that a broker in Forex doesn't want you to lose. They don't want you to win. They don't care. They just want you to trade. They have a zero vested interest in anything that you do other than just them wanting you to put money into the trade. So every time you start a trade, you're going to instantly see that it's at a loss. Why that is because that's the money that they made. That's their so if you enter into the trade, you're instantly going to be down like a pip or two or whatever the case may be, and whatever your pip value is, that's the amount of money that you're instantly going to be down. No matter what happens, that's the broker. They're making their cut. In a binary world, it doesn't work that way. In a binary world, it's very similar to like a casino betting or sports betting is a really good example of that, or what have you, where if I go to a binary broker and I bet, like, let's say I go to a casino and I'm betting, like, I don't know, I'm not good at sports teams, but let's say, the Packers versus the Lions, right? And I know the Packers are going to destroy the Lions, and that's a pretty sure bet, right? It's a pretty sure bet that that's going to happen. If I give them $100, they're not going to give me, in return, they're not going to give me over 100% of that balance because it's a sure win. I might win $40 back or $50 back or whatever the case might be. But if I lose that whole amount. But I can't lose anything more than that. So if I go to a binary broker and they're going to have a rate, it's usually about 80% scale. Sometimes it's 70. Some in cases it's lower than that. If I put up $100, I can, if I win, I know I can win then $180. So I got my $100 back plus the 80 that they need. But if I lose all of my 100. So the benefit there is that I know my outcome. I know I'm either going to gain 180 or I'm going to lose my 100. Okay, so I'm going to either profit 80% or I'm going to lose. As a result of that, you need to have a higher rate of success. If you cannot just break even. In Forex, you can break even. You can have half your winning trades and half your losing trades and still make money. You can actually, like us, we can have a 40% win rate and still make money because we're able to strategize that instead of getting $80 back on our 100, we can get $800 back on our 100. Okay, but likewise with Forex, you can dramatically lose, too, if you're not safe. That $100, I can put up $100 and lose 1,000. That's silly. I could lose 10. I could lose everything. It's unlimited how much I could potentially lose. But you are able to still control that like the binary world, and that's through the uses of stop losses. So I put stop losses up all over the place. And every single trade, no matter what it is, I always have a stop loss. I don't always have to take profit because I haven't let the market do what it was going to do. But I do know that if the market goes against me and it goes in the wrong direction, there's a point where I said, okay, if it's going this far and it went this way, I don't care what it's doing anymore. That's as much as we're going to chew off. And if it just so happens that the next round it goes back up, oh, so be it. That's just how it goes. And because for all those times that it happened, there's going to be events that thing's just going to keep climbing and climbing and climbing from there. So that's Antoine. Do you have any additional questions on that, or I think Bill was with us last week, but any additional questions on that structure at all? Okay. Well, if nobody has any questions on that, I'm going to go into our trading platform. This is not my trading platform. I do not own this. I do not get paid for recommending this trading platform at all. Oanda, in my opinion, and this is just my opinion, they're the best broker that's out there, the very, very best. They have the lowest pip spread because they don't play any gimmicks. Okay, they don't offer any incentives or anything. They don't do these freezes and these slippages and all these different terms. Slippage, for instance, would be if you're like in a binary broker, they're notorious for this because they do want you to lose, because if everybody won in binaries, the broker loses. Okay, the broker loses. But in the Forex world, it's not necessarily like that because of a pip spread. But I totally lost track of my thought there. With Oanda, why I like them? They have a very low pip spread. They don't play any games. They're always one step above regulation. So they're U.S. regulated, and by far, the United States has the most stringent and strict compliance and regulation measurements for brokers in the U.S., to the extent that there's brokers that don't even want to deal with it. United States, they don't want to go in there. They want to just cater to everybody else outside or whatever the case might be. And in other countries, with that same regard, they're getting regulated. They're no longer even accepting U.S. Citizens for whatever given reasons based on the particular regulations that they want to have. Oanda trades with very low leverage. They have 50. That's their very max that they offer, 50 to 1. So if I have $1, I'm getting $50 into the market. That's very important because with high leverage, you can lose a lot if you're not smart with that. And most people are not smart. In the United States prior, the highest, it was very popular about 10 years ago to go as high as $400. And you would always hear these incredible success stories where people got lucky. They put in a couple dollars, and all of a sudden, bam, their $10 made $800. Their $800 made $10,000. Their $100,000 made $2 million in 3 months. How is it even possible? Yeah, but for every one of those stories, there's countless stories of people that are just losing their butt because people just, in general, they that's why regulation exists, is people are susceptible to their own weaknesses. They're susceptible to that, and the government had to go in there and say, hey, this isn't right. Just because you guys are allowed to do that, you're blatantly losing money, and you're blatantly hurting yourself and destroying economies and blah blah blah, or whatever the case might be. And they had this to play. Oanda had 50 to 1 leverage even before the United States made it regulated. Even recently now, they're even changing it up even more so, where come January 30th, you're no longer able to supply your account with PayPal or a credit card, which bummed me out a little because I was always going with my PayPal account, but you can write a check to them, you can do a bank wire transfer or whatever the case might be. But I would bet any money on there's probably talk with the NFA and the CFTC and all that other stuff where there's probably a move being ready to be made that's probably going to be a new line of measurement across the board. So I always look to Oanda really for everything. I don't see them play any gimmicks or games. The drawback of Oanda is that their charting is butt ugly. It's ugly. You look at other platforms that are out there, and they're colorful, they're graphical, they're nice. They have all these indicators and toys that you can play around with. And Oanda is just a very ugly platform in general. But I like it, not only for all the given reasons that I said from a company standpoint, but from the ability that allows me to fluctuate my trade size. So I can go in to Oanda, and I can pick whatever amount I want to trade. I can trade with as little as a penny. I could trade with, I think they even like 100 lots or something like that, or any amount in between. If you trade with MetaTrader, which is a trading platform, very popular trading platform, you're regulated. You're required to trade in certain increments. So like 0.01, like a micro lot you might have heard of, or a nano lot, or a standard lot. I know all these you have to trade in those increments, but in Oanda it doesn't allow that. So somebody that comes to the table with $5, you can literally trade on Oanda with $5. Now, it doesn't mean you're going to be an overnight success, but you can still learn Forex. You can trade with real money than anything else. And I always recommend that, even if you're just trying to learn the ropes on Forex and getting a handle on things, we're probably really the best game in town, because for $10 a month, you're going to get the education behind it. It's much better to trade even with $5 than the demo trade. Because demo trade, you just do not have the psychological aspects. If you lose a trade, no big deal. You do not learn. But if you're putting $5 at the table, you don't want to lose your $5 over and over again. So you still struggle you fight with the emotions even over $5, which sounds weird. I'm a very avid poker player, and so but I don't play with high money. I play dollar tables, right? And it's funny the high emotions that people have over $1. Now, like today, I just had lunch, and I paid like $14 for lunch, and I didn't even think about it, or dinner rather. I had a late, we can call it a late lunch. But in a poker table or in a Forex arena, when you're betting even a small amount of money, you find yourself fighting those emotions a lot more. There's a lot more on the roads, on the line, and that's something that you have to overcome in this arena. Like, I can take all these different trades, have all kinds of things, take some phenomenal losses, take some spectacular wins, and it's really not going to it just doesn't affect me one way or the other because I know my win rate. I know where my success rate is at. So we're going to go through this platform here. So you can either log in online to your own Oanda account. It's free to sign up for a demo. They have an unlimited demo account. I do recommend you put in your real information. That somebody will call you from Oanda. But they're nice people. And you don't have to if you don't. You can put any fake thing you want. But it does make the transfer from demo to live a lot easier if you already have all that stuff in play and you have an established relationship with them. Because even though I just set up a demo account last week just for this purposes, and somebody called me and it's Sean and blah, blah, blah. Okay, so here's Oanda FX Trade practice account. The first thing that you want to do is go under Tools and under User Preferences, and you want to set this up so that it's working the best for you for in the method that we trade. So you don't have to sit manually trade each single time and put in a different number. It'll automatically just pop it up for you. So on here, what do we have? Trend line, blah blah blah. You can choose how you want your calendar, or not your calendar, your chart to look. So you can click to have it ignore weekend data, and so like the market's 24/7. So most of your brokers are going to be shut down 24 or 24/5, right? Where like on Friday night, it's done until, again, Sunday evening when the Asian market opens up. But even still, there are brokers, and they used to do this, but recently they had stopped. But you could actually trade during the weekend. The pip spread is really high because there's very low liquidity, but you could still have those candlesticks in there. For some people, mentally, when they're looking at a candlestick, and we can talk about charts, guys, I want to talk about charts here in a little bit, mentally that would goof them up, so they would want to take that data out. So I always have that data out because I don't care what's happening on a Saturday. I really don't care what's happening Sunday morning, because just because there's zero. It moves around a little bit, it's really not going to make any much difference to me. You can change your daily calendar set time. If you want your candlesticks to represent like a different time zone, you can do that right there, in your local time or New York time or what have you. I don't chart with Oanda. I prefer MetaTrader just because I still like the look and the feel of it, but I enter all of my trades into Oanda. So if you catch me on that, I have an Oanda demo account that I chart on, that I look at. I just like the look and feel of that because they're Oanda is butt ugly. But I make all of my trades on this trading platform. All right, so the quotations. So when you go into the quotes, and these are all over here. Let me just move them all. These are all the different pairs that Oanda has available. So they pretty much have everything. So I trade the Aussie Canadian dollar, Aus Rock. No, that's the Hong Kong dollar. We don't do that, guy. What's happening here? Aussie New Zealand dollar. So you can move in here all the different quotes. I'll do it now so you guys can see, so you can line this all up. Maybe I'll even put the list of this on the site, on our Facebook group. Why I don't trade all of them is because some of these pairs are just extremely volatile and unpredictable. Like that's like the Norwegian krone and the Hong Kong and the Denmark. I have no idea about some of these pairs. I don't. Their news events are very enticing. They're not really movers and shakers, so things are just flipping around crazy. And for me, it's just an unpredictable market, very chaotic. So I stay out of it. But if you look at all of these pairs, you're going to see that a lot of them correlate. You're going to see, so I trade the Aussie dollar, I trade Canadian dollar, I trade the yen, I trade the U.S. dollar, and I trade the franc. Right now I have suspended franc trades for the time being. But I think it comes out to like 28 pairs is what we look at. Yeah. For anybody coming in, if you have a question, you're going to see the My Mood on the top. You can click have a question or something like that, or raise hand, and then I'll see if you guys have a question, and then I can address it at that point. So these are all the trades that I'm in, all the potential trades. So it adds up to 28. I'll get the complete list later, and I'll put it in the Facebook group so you guys can match that up. But then you can just have that ready. Okay. Periods. I only do, I only trade on the daily chart. You don't need to adjust this if you want to just look at things on any other level. All I do is I just look at the daily chart. Trading, now this is the important section. The market default is going to just have the last trade that you're in or what have you. But the order size is the important thing here. The order size, what that's going to do is that's going to regulate how much you're entering into the market on every single trade. And because we're in 28 different pairs that we're monitoring, you don't want to over leverage yourself. You don't want to be in too many trades at once. One, because of the psychological effect that it's going to have on you if something's going the wrong way. Granted, if you're winning, like, well, if you're on that pound New Zealand dollar that we have that's pushing 900 pips, and if you're over leveraged on that, you're probably pretty excited because you're making a good amount of money. But really, I think for us, it's only like a 5% gain, which is still a very respectable gain. But it's just keeping our emotions in check. So if you just buy 28 into 100, you're going to come out with like 3.57 or something ridiculous like that. So it's our recommendation. I can't force anybody to do anything, but it's our recommendation to not trade anything more than 3.5%. Now, that said, out of our official results, the verified site that we have that monitors all of our trades and keeps us accountable for everything with our 100% transparency, that's based on roughly 1%. So with that said, right now we're at 20-some% for the month. Somebody that's been doing like 3.5%, they could have all those results. Almost like a 70% gain this month. But that also said, this last week, we took a 7% hit this last week. That person then would also then took about a 20% hit. So you really got to gauge. So there can be a big difference even from 1 to 3.5%. So you really need to gauge the risk tolerance. If at any point you're waking up in the middle of the night to look at these charts or something like that because something's going in the wrong direction, you really need to scale back. Because when you have too many emotions in the game, it's going to change your decisions. You're not going to follow along with the signals. You're going to get out, when you're really not supposed to, or when I wouldn't necessarily recommend it. And then, just kind of go from that structure. So if you put in 3.5%, you want to select on the percentage of leveraged NAV. So that's your net asset value. Okay, all this other stuff we don't really care about because I'll tell you what the trailing the stop loss is and when to pull out of the market and all that stuff with our updates. But everything else we don't really need to worry about. But what happens is if you click on apply and save and you come back over and you select on a new trade, it's going to auto-populate the amount of units that you have in there. So if we move, and we're going to do like a franc yen short, it's going to automatically just put that in, right? So it automatically just pops that guy in there. And then when I call out a stop loss, I might say like 4.125. I'm making up numbers here. Then you'll click submit, all right? But what's interesting to note is when you look at, pay attention to this number here where it says margin used, 3,358, right? Now let's go over here. Margin used. Margin never changes. The units change. So the pip value is going to change, right? You see the pip value changing. But the amount of margin that you have in the game isn't going to change. So the concept there is that you can never get yourself into a situation where you're going to get a margin call. Some people, if you want to be a little bit more, I'm not going to call it a risk taking, but if you want to have it a little more level across the board, you can manually on your own look at your balance. You would pretty much do this every single trade. Look at your current available margin available, right? So 95955.88 times 0.035, and then know that that's how much leverage that you'd be able to have. So then you could go in there and you could manually pop that in there. Or what's another good way to look at that? Or another way is if you're looking at the entire balance that you have, you don't want to trade anything more than, in this case, 95,955 units. So that's another way you can go about that. We're at where's the U.S. dollar? You wouldn't want to go anything more than like that. But that's truly extending it out. So you would have to figure out like a middle road where it's going to level out the pip size. So what I'm trying to get at is if you wanted the pips to always be the same. So if you wanted the pip value to always be $5 or $6 or whatever the case might be, that's where you're going to be able to want to manually adjust. And how you do that is, again, in user preferences, trading, USD or units. Depends on how you want to calculate it. So if we did dollars, and we said we want the default dollar size to be, 35,000. I save, and now there you go. So now default and all that stuff. So now the trade value is 35,000, or as close as it can be to it. Zero. That's that trade value. Trade value. Trade value. All right. So I'm going to assume that's making sense because nobody's got any questions. We almost always enter in on a market order. What a market order means is when a trade is called, you can just go into it at any point. That's done with some intention because it's a good area where I feel that the market's going to move into. But since we're trading so long term, I know a couple of people had some questions where they woke up, they didn't wake up when they traded like 1 in the morning or wherever they were, and it was like 6 hours later, and they asked, hey, is it an okay time to get into the trade? And yes, it's usually, there's not any single day that's really, unless there's a real extreme move during the London session, there's any one trading session that's really going to make a big difference if you got in a little bit earlier or got in a little bit late. In some cases, it can work to your advantage. Like let's say the Aussie Canadian dollar does drop, right? It's already 100 pips the wrong way. So now this person would have a 100 pip advantage over everybody else. Or if it still continue to lose, right, they still had an advantage because now they're closer to the stop loss than they were before. So if you wanted to be a little bit more conservative, if you did put a limit order on any of them, you'd want to put it at the break of the candle going in the direction that we want it to go. So you could do that if you wanted to. If you wanted to just set it and forget it and not worry about it, and then it's going to go into that direction. So you could do that. There's really no significant drawback to doing that. The drawback would be that sometimes a candle, the wick is really long. So you could be missing like 60 to 100 pips or something like that. We're really whatever that individual day had you at. Okay, so let me pop out of that guy. That was the biggest thing. Oh my God, here's a little calculator for you. So if you wanted to figure out like the different unit sizes on things, or if you wanted to equate your pips to mean something, you can do that there. And let's go here. So there's different ways that you can enter into the trade. Up here, we're in a new trade. This is almost always how I do that. You click on this button. You can multiple. You don't always have to click on new trade. So you could enter a trade for the U.S. dollar, and then hop over to pound dollar, and you can just keep moving in. You can just keep moving into the market that way. The same with down here. You can just click on these, and it'll just pop it up right away for you. But because we're in so many different pairs, I mean, to me, I have ADHD, so this is it's very seizure inducing. You could erase these if you wanted. You can get rid of them by just moving it over to the quote list, and then even then, that's still wigging out a little bit. You can just totally get rid of something you wanted to by clicking up here. So it's a very versatile platform. Over here, now this is the total that you have in your account. Your unrealized balance is what is happening in the market right now. So if we're winning or if we're losing, this is what we know. This would be the percent that we're up or the percentage that we're down. That doesn't an unrealized win or loss is just that. It's unrealized. So all of our official results that we have, we will never brag about how we're up if we haven't closed out that trade. So when we say we're up like 24% or whatever it is, those are trades that have closed, that they're done and they're out. Because if we or also we just numbers, not falsifying, but we'd be giving misleading numbers. Because if you add on what we currently are up, I think we're up like another 8% or so. So then we could boast that we're at 32%, but that's not true because these trades have not closed. You base all your trades off of that net asset value, though, because we hang on trades for quite some time. Our average trade is like 10 days, 9 to 10, 8 to 10 days, somewhere in that range. That's our average. Our winners, sometimes our winners, we're in it for like a month. So if you see a trade that's going on for some time, that's probably a pretty good thing because probably up in the money with that. It's doing the portfolio pretty good. But as a result of that, you want to make sure that you're reflecting the increase. You're compounding your trades on those. Even though if you're up 20% on an unrealized profit, you want to trade off of 120,000, not just 100,000, because you want to be able to take advantage of that momentum. And that's how you can compound your earnings a little bit easier. Likewise, if it's going in the opposite direction, that's a pretty good indication that'll help you slow down too. That, okay, now is not a good time to just keep dumping in because we're on a lose streak or whatever the case might be. It's going to just hedge off some of those losses. So that's you always want to trade off with the net asset value. This is I do not do this, but an additional. It's really for somebody that is adding new money to the account, where that, like, let's say for instance you start off and you start off with $100, right? And then every month you're just going to add another $100 to your account out of your paycheck or some business income or whatever it is that you're doing. Those greatly fluctuate your trade size because one month you could still have some other trader in there, and now you're entering. The portfolio is becoming a little bit lopsided. It's becoming uneven. Okay, you could do a rebalance. Like you could rebalance it on your own if you wanted to. And how you do that is you would just look at whatever given trade that you have. So if you're in the euro dollar, you have like 100 units or something like that. And now you should be trading at 200 units after you've entered in that money. You could just put in that additional amount for the rest of the ride on that trade. You're still not going to get the actual value out of that because you would have missed out on any gain. But it just regulates just a little bit better as you're building up an account. Because the whole concept of this was really designed for just money to compounding on its own, but I recognize that people are throwing additional dollars into it, and that's probably a pretty good way to be able to hedge that all off and be able to compound your growth as you're adding additional dollars into that, as opposed to having a one trade that's like forever old, and then by the time it wins, it almost did nothing to the account balance because it might have been in there, missed out on like a whole month of whole weeks of gains or whatever because you threw some additional dollars in there. Margin alert. So if my margin, we're losing this bad. Imagine this. We're losing that bad. It's getting down to $1,000. This is a demo account. We would have to lose we'd have to be down like $90,000 or something like that. it would trigger an alert, and any open trade we would have would instantly close. This is why low leverage is important. Without low leverage, if you had a high leverage, that amount would be much higher. Okay, so 500. In some places in the world, you can get 500 to 1 leverage. That amount would now be 10,000. Right. So if I was, or even in some places you could have 1,000, that'd be 20,000. So it's even still. It's very likely that we're going to lose 75% of your event. It's statistically impossible to lose anything more than, I think, like 34 or 40% of your account balance with us, or what have you. Deb, go ahead. Welcome to you mentioned that. You would do 1%. What I mean by 1% is of your net asset value. So when you're over here, under user preferences, you would just put 1% of that leverage NAV. Apply and save. If you do not use Oanda, you'll have to calculate that on your own. So if you're like using MetaTrader, calculate that on your own. The unfortunate side is if you're using MetaTrader and you have a very low account, you're not going to be able to get down to that. You're going to find yourself trading like really about 20% of your account, and then that's when I get questions like, is this going to go this direction? Anytime I get that question, leverage. It's like a sure hit to me. It's, hey, someone over leverage there. But that's the solution there. What else? Any questions so far on Oanda? And that's pretty much the setup of it. If you need to manually close things out, because every now and again I'll this week I had to manually stop out. We had some profits on the U.S. dollar yen. And it did go down, so, I mean, somebody that wanted to ignore me, they would still have a little bit more profit, but we pulled out in profit, and then you would just close it and submit. If you sometimes take profit or a stop loss, usually it's a stop loss that will modify. If I determine to take profit, I usually do it instantly, where it's like I know there's some significant stop, a support and resistance line, and I think it's going to go up, but if it goes up, it's probably not going to get beyond that, so I'll take our profit here. That take profit is almost always, it's always, not almost always going to be twice that of our stop loss. So if I see something like that and there's not enough margin for us, I'm not going to take that trade, because there's 28 different pairs, and I look at 28 different pairs every single day, and there's always going to be an opportunity later on to take the highest probability that there is. Let me go back here real quick. So realized profit loss, again, this is granted, this is a demo count, but that's how much that we then lost. Just me trading around, goofing around, clicking things. That's how much we've actually won or lost of this account. This is going to say how much margin that we're currently using. That's going to be how much margin is available. Again, that's going to be just this minus that, so that's going to be the margin close of value. And then, the position value that you have in the account right now. So if you continue to add more trades, that position value is going to get higher. Forex 101 for you guys. There's technical analysis that you can use in here. There's news that you can look in here. I do look at the news, but I make no attempts to trade the news. Okay, because inherently I am trading news. Well, what I do, being from a long-term perspective, is I probably trade 70% technical, and maybe even 80% technical and 20% fundamental. What does that mean? Technical is a technician, a technical trader, somebody that's just looking at the chart, whether it's price actions or they use a set of indicators, whatever the case might be on that level. A fundamental trader is somebody that's looking at news events. Okay, they're watching the news they're saying, okay, the Greece is bankrupt. The yen or the Nike just made a deal with so and so. Jimmy Carter flew over to Somalia. So they're looking at the like whether it's the socio-political or economic, the standpoint behind the government, or whatever it is that they're looking at. There's usually a news event that's surrounding it. The biggest one in the United States, other than presidential elections and what have you, is going to be the non-farm payroll that's reported every Friday, the first Friday of every month. And if it's a falls on a holiday, then it comes like the day before or the day after, and whatnot. And what that is, that's just a report. And you always hear it, if you turn on the news, always going to mention that number. It happens every single month, and then no matter what happens, the president's to blame. No matter what is. Whether this president, the next president, it's always to blame that it wasn't high enough or whatever, what have you. There's a significant number that people watch, and they tend to trade it. What's interesting is that nobody ever knows the direction. Inherently, you would think that if we had more jobs and put people more at work, that's going to fill the economy, positive dollar, right? So people could do that, but there could be speculation on the opposite side of the dollar, where, we're trading the euro dollar, and maybe the dollar's doing good, but what's happening on the euro side of things? Maybe there's some European event that's going on that's really offsetting that, because in all these different pairs, that's what you're doing. You're buying one and selling the other. You're two. All the time. It's one versus the other. What's the euro doing versus the dollar? When you're looking at this, let's look at the euro dollar right now. Let's pull this up. When you're looking at this chart, and we see that's letting us know that if I were to go to Europe right now, it would cost $1.11 at 1 euro. Right? So it would cost me $1.11 to get 1 euro, which right now is pretty good, because there was quite some time when the euro was whooping our butt. Let's scroll back here. I can't even go back. Hold on, I'm going to continue that chart. That's why. Okay, let's go back. I'm seeing. I think it got up like a few, like in 08, something like that. It got up to like when the U.S. was going through all those problems and the dollar was tanking. It got up to like $1.50 or something like that. So it was very cheap. A lot of Europeans are going to New York because it was very cheap for them to come over to the United States and tour it up over here and buy all their goods, and it was very costly for us. 50% to go to Europe. Ticket prices are high, tourism is very high. So that in a nutshell is what we're trading when we're trading forex. We're looking at one pair versus the other. So if we're again on the euro Canadian dollar, or the LUD, call that, it's again the same thing. How many Canadian dollars does it cost to buy 1 euro? And now it's like 1.4, and then we could do the same thing with so it would be $1.25 of Canadian dollars to buy a dollar, and that's really kind of that's just how exchange works. That's it in a nutshell. We just break it down to the umpteenth percentage of that to actually pull a profit off of that. So if there's no questions so far, I'm gonna walk you through this high level price charting 101. I guess is the way you want to see it. So I'll look at a chart. That's what everybody wants to know. How do you trade, Sean? All right, how do you trade? I want to be a trader. All right. So we'll look at a chart. And now, looking at this, what would be my immediate thought? Right? It's going down. The euro dollar has been going down because every one of these candles is a day. So, for me, it would take a good amount of price action for me to consider the idea that price is going to go up. So every time you look at a candle, I want you to think of this. I want you to think that every candle had a story. Every candle told the story of the day. Taking a drink, sorry. And there's two competing forces. There's what are the bears and what you call the bulls, the longs and the shorts, people that are buying, people that are selling. Bears are down, so think of a bear attacking, right? It's pouncing down on somebody. And I don't know if this is where they came up with these terms, but just in your mind, that's what a bear is getting up and pouncing down on somebody. But what's a bull doing? It's lowering his head and it's raising, it's bucking up. Bears are down. Long is up, short is down. Call up, put down. These are all different terms that are essentially meaning the same thing. So call up, put down. That's not the real name for it, but call it put. You get the idea. So every story, every candle's telling a story. So let me zoom in here. Okay. So this is the breakdown of the candle. We'll look at this candle here. The first thing you want to look at is where it started. So right here, this is the opening price that it started. If it's red or whatever, me personally, red is bear. Green is a bull. On a traditional candlestick, white is a bull, and black is a bear. Okay, but I just like green. So this is the opening. This wick up here represents how high it got. Okay. It dropped, came down here. This is the lowest price dropped, and then it pulled back a little. And then it started off the next day. This is where it opened. This is as high as it got. This is as low as it got. And then you had Saturday and Sunday, and then Monday. Okay, as high as it got, as low as it got. So what? All right. So let's start here. Weekend opened up. The bulls started buying. Maybe there could have been a lot of struggle in the market or whatnot, but there wasn't a lot of push in any one direction. This is also considered what's called an inside bar. That means this bar did not extend out past this. So to me, I'm making like zero decision on this. I'm like nothing's going on here because it didn't go down. So now the next day, now the bears got in control. They're like, all right, we're done having this. So it kind of went up, didn't happen. Now it's going down. But they couldn't even close really past the end of this, and it's still inside bar to this guy. All right. Now over here, price started shooting up, but it fell back down. So while the wick is important to note. When you see a long wick, now this is a rule of thumb. This isn't like hard science. This is not hard. But like a basic rule of thumb, like just drinking 8 hours of 8 glasses of water a day, sleeping 8 hours. If you have a long wick, trying to push in the opposite direction. Now I'm saying it's generally trying to push. That doesn't mean it can win. It can lose. There could still be enough opposition on the other side, but that's what it generally means. So here we had a move up, and it fell. The bull candle, there's a long wick, and then what happened the next day? Obviously, it's easy for me to predict this because I'm seeing what's happening here, but nonetheless, now we saw a significant drop. Now, this would bring my attention because it fell past this mark. Okay. And then again, now, for me, why I'm kind of over-shorting the dollar is because it's just been spilling. It's done what it's. It's just my opinion, but it's done what it's going to do. This is just me, right? So people are going to disagree. At least half the people have to disagree with me that I could continue to lower. But what I'm waiting for is what's called a retracement. And this would be a good example of a retracement up here. Things fell, started coming back up, and then it fell again. So for me, it fell, went up, and then I want it to fall past this mark again, and then have the stop loss up here. There must have been something crazy going on. Unless I did short this. I don't know. We'd have to look back at it. But this is almost a perfect setup where it goes down, goes back up, falls, closes past this, and I would enter in on this guy, and then everybody would be yelling at me, Sean, it went the wrong way. And then finally, it did what it did. Sean, it's going the wrong way. What's happening? And then boom, 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 because it still never got to the height of this guy. or stop here, or I might even have the stop up about there to give it some movement. It just went down, but I would have probably pulled out at one of these like probably even up there, maybe even there, where it kind of just starts. This is probably where I would have got out. I would have, then everyone would have been like, oh, but it kept going down. And for me, you're always going to put money on the table. No matter what it is, you're always going to leave money on the table. You can't get around that. So that's a candlestick. Okay, I'm not going to go into any. These are all kinds of crazy bars that people have that are just ridiculous. And I just like candles because it's a very basic story. The next thing I look at is I look at resistance points, so I'll scale back and I'll look to see, because price tends to bounce between areas, and usually it's from like a psychological factor. So round numbers, like if a price is getting towards a round number, some people, they just have it in their head that the price can't ever go lower than that. Like just before, I was like, hey, I'm done showing this dollar. I don't think it can go any lower. That's my personal thought. Somebody else might think it might go to a $1.10 or a buck even, but whatever. I think someone's going to get involved and start changing things up. But I look at areas of stop and resistance. Okay. So here, and I look at areas, not lines. So here is like an area of resistance. Resistance means if this goes up, stop and resistance is essentially the same line. So price went up, bounced back down, went up. That's resistance. But here, this is a good example of support and resistance, where it's, again, the same area where price popped down, right? It couldn't get past it. Then it did, bounced again off of it, went up, bounced again off of it, went, and so this area here is pretty good. And then look what happened. Bounced here, bounced there, and then it tumbled. So you always look for areas of it. So I'm always looking, every time I'm looking at a pair, I'm like, okay, where's it going to go next? Where's it going to go next? Here, I mean, there's a free fall. I mean, you probably have to scroll back pretty far. I mean, look what day was that? Like July of what? Is that last year, like years ago? Yeah, it's like July 30th of 2012. It's pretty so muddy. So these are, wow, that is real low. That is really low. But yeah, so you would look for that, so I bet any money, if we look here and we scroll here, yeah, if you scroll in, there was like a day where it was like different through that, and it had to drop down. So that's one area that you look at. I'm a naked trader. I don't trade naked. Sometimes I do. Sometimes I trade naked. But I look at price action, because in my mind I just see where the trends are. So stop and resistance is a one good point for you to always look at. The second point is trends. What a trend is, like this would be a good example of a trend, where price goes up, bounces, goes up, bounces, goes up, bounces, goes back up. So in your mind, you could draw, like some people just do that. They draw a trend line. Or you could just, look at where all the different bounces it had, And there's no science to drawing a trend line at all. It's just like an art. You just draw a line, and it's like if you're somewhere in the ballpark, you're good to go. So we're looking at this trend line, right? Usually you don't want to draw a trend line until you see like a third bounce. Then it's like an established trend line. But you can do it after even a first bounce. There's no right or wrong to it. It's really an art. So we're looking at this trend line. So boom, it bounces, comes up. That would probably have been a good area to buy, right? So you're buying because, we're buying. It's going up. It's bouncing again. Again, that could have been a pretty good area to buy. I wouldn't be excited about selling off this area if I'm believing the uptrend. Now, some other people might say, well, hey, it's coming off this resistance. Maybe that's a beautiful time to buy it. Maybe it's going to continue to spill down. And they very well could be right, too. And in this case over here, people that were believing that, it sure the heck went off, didn't it? Look at that line right there. It's almost perfect where it just took that tumble there. Because somebody out there with big money said, hey, if it gets back up to that one, the heck with it. We're selling off everything. But then once it broke past that, you always want to look at when trends break, right? When they break, this potentially could have been a pretty good area to short as well. because it broke past, and you see it struggled, and now it's struggling on the other end, and then finally, so if you combine those two, look at a trend line and a horizontal line. So, like say we know this to be a area of support and resistance. Then the question is, how would you trade that? It's easier to draw a line, and you're going to trade that. No, I'm going to do my best to speculate. I mean, I would have liked taken a buy somewhere in here, because this would have been I would have been just ticked off at this. Because to me, this would have been like a down, so I would have probably shorted somewhere, probably around there. Got in there, and then I would have probably pulled out, right around there when it got back up, to lock in some profits. But nonetheless, okay, so now we're over here. So we're going back down. It's coming up. This would have been a good area to buy right here. I would have probably taken my take profit here where that line of resistance is. So I would have put in the trade that, hey, we're going in, and this is where I want to get out, right at that line. And then that's where we would have got out, and then it would have plummeted, and then it would have hit this, and I would have been like, hey, great, let's buy in again, because this trend's still continuing. So then that would happen, and I would have likely again, I would have set our stop loss below this, okay, and then I would have probably taken profit here. So if you look at that distance, this is easily 2 to 3 times greater than the stop loss. Anytime you're entering into a take profit, you always want it twice as greater than your stop loss, because then if you flip a coin, all of you, every last one of you would take this bet that if we flipped coins, and every time it was heads, $1, and every time it was tails, you would give me 50 cents. You would take that trade every single day, and that's what you can do in Forex. You can create that. Now, it's not as easy as a 50% win rate, but if you just did that alone, I promise you, your losses would be significantly, because of the fact that the market can it's either going to go up or it's either going to go down, but it's not quite a 50-50 shot, because it's actually more of a 25% shot, because the market's going to go up or down, but your coin can be heads or tails. So like if I flip the coin heads, well, that's 50% on the coin. There's still 50% on the market moving up and down. It's still not truly 50%, because there's a lot of economic dealings behind it, but you understand the point on that. So that's one thing that I look at from there. Any questions so far? I'm getting a little wordy, so I don't know if we should break this into. You guys like this? Hands up if you like this, and if I should just keep going here. No hands up. Okay, well, hands up. Okay. All right, so that's one trend line. Here's another one of my favorites, Fibonacci. All right, Fibonacci retracement. This is, and I can see this stuff now. And after a while, so there's no. I don't knock anybody for using indicators. Here's what I do not like. I don't like when people use an indicator and then they say, well, this indicator said therefore the market's going to do this and you should do that. That it doesn't work. Here's how every single indicator is ever created, with the exception of just like moving averages and what have you. Most all of them were created like I look at like SAR, like a stop and reverse, right? Like the PSAR, right? That was invented by, I can't even remember that guy's. I read his book too. It's this big, ugly, stupid, long book. This guy created like about 5 or 6 different indicators that are, and that was based on the commodities market, but it was very specific to soybean in the 70s. So this guy made a zillion of dollars because he figured out this stop and reverse calculation created an, and it was like, oh my God, in the 70s, I made bazillions of dollars because this soybean market at that time perfectly fit this indicator. So now everybody and their mother has this indicator now. It's a standard stop and reverse indicator. It's very simple. I mean, you see it's like these little dots that fall, and then when price hits, it turns around. It doesn't work like that in the current market. In the 70s, things moved slow. not everybody would trade it. Like, I don't even think the 401ks existed at that point. Maybe it did. I don't even. But like, the market wasn't as it is today, right? It moved very slow. So this guy, you could use indicators and then falter, around that. And people still try to then to look at that indicator today and make a judgment around it that, hey, it did this, so it had to that. You might hear something called a point and figure chart. One guy made $1 bazillion in the stock market in the 80s because every time a stock moved up $1, he would draw a line. And he would never count any reverses unless it went down $1 or up $1. And he would draw another dot on it, another dot, another dot. Made bazillions of dollars. Now people sit there and trade that thing like it's gold, and they're still losing money all over the place. Or some people, like Darvis, this guy created a box. Like, and again, I think this is like in the 50s even, or the 30s, or it might have been the 30s. It was like this guy, he was a nobody. He was like a shoe shine kid. Is that a question, Deb? Yeah, it's like one of those questions I don't know. I look at price action. I'm not a future. Here's why I know it's going to go up when it went up. And when it goes up, and I see it, then I'm going to go into it. What I'm not going to do is I'm not going to say, well, it's at an all-time low. It certainly can't get any lower, so let's go ahead and buy now. Where's our stop loss going to be then? I mean, there's no action around that. It's dropping for a reason, whether it's some government that's pushing it down or somebody, buying up one currency or selling off the other, or there's some economic turnaround or some fundamental reason behind it. I don't care to guess. I'm always going to come into the market too late, and I'm always going to come out of the market too early. So what I mean by that is I'm never going to catch. I would ever, like in a perfect world, I would have gotten on the trade there, right, at the high, and then pulled out here at the low. But nobody can do that. But everybody thinks that trading the market is trying to predict the market. Everybody thinks that. So guys, when you look at like going CNBC and all this stuff, and people are always going to stick, it can't. It's just guessing. All it is fortune telling. And I'll be honest, like sometimes fortune tellers are right, but it's because they've said enough bullshit that step back for a moment. If anybody believes in all that stuff, then it's 100% true for the person that believes it because it's their reality. But here's a little event that happened to me personally. When I was in college, there was a guy, a professor, that had out a survey. It was a very detailed survey. Our date of birth, when we were born, what our parents were, what we wanted to do when we got older. We had like a little handwriting analysis sample that we wrote in cursive when people actually still wrote in cursive, and we handed it all into him. Okay, this actually happened. Today he came back and he said he created a detailed, specific horoscope for all of us. So we all read it. All right. And this is like it was a logic class, but here nor there. And we all read it, and he asked us to raise our hands. Of course, it pertained to me and you, or to me personally, right? So I gave him all the information and pertained exactly to me, and I was like, so I raised my hand. And, oh my God, this guy had me spot on, right? So then he had us hand it to the person next to us, and then we started reading it, and pretty soon we all started giggling because we all had the scope. 20 to 30 kids all wrote down something individual, and they all came out with the same result. So, I don't know what my rationale with this is, but I don't try to predict the market. I let the market. I could have all the positive feeling in the world. I could say every day, but that's not going to change the economic structure around everything. I'm going to wait till with the market. I'm going to wait till it's actually doing something. I have to see it first. And then get on the ride. Like if I'm a surfer, right, this is the greatest example I think I have. It's like surfing. If there's no waves, I'm not going to be I'm just a dude on a paddleboard in the ocean. waiting for the wave to come, waiting for the wave to come. I'm not going to stand up on the board and act like I'm surfing because then I'm just going to fall down, or, there's stability on that, or I'm not, it's not even fun. I'm essentially losing because I'm not surfing, right? So I wait for the wave, I get up on my board, I paddle along on that wave. And when I try to stand up, then I'm riding that wave. But at some point, I have to get off that wave. I'm never riding the wave all the way to the beach, and I'm just stepping off my board. At some point, you exit that wave. You crash. And that's how this market. I'm not looking to take the entire thing. I just want a piece of it. That's all I want. I want a piece of it, and I just have to be very good at getting those pieces. And that's all I want. And sometimes I'm wrong. A lot of times I'm wrong. 60% of the time I'm wrong. But it's the 40% of the time that I'm really right. I'm waiting for that big kahuna or whatever it is. I'm not even a surfer, so I don't know why I keep giving these analogies, but that's what I always think of when I think of a trend. I think of a wave. I think of riding that thing. And I try to ride it until the point where before it crashes on me, I want to be the one to dive into the water so I can control crash, over my head. So no, I'm never going to ever predict anything. What I do, here's the best of my predictions. Let's go back to the let's go back here. So I'm looking at this thing. This is the one that I just called the other day, and I said, wow, there's a lot of resistance here. Let me zoom in. There's a lot of crap that's going on over here, right? Not a lot of nonsense. What do I see here? I saw two significant drops. So market has been climbing. It tried getting high, and it sank. And then the next day, it tried again, and then it still sunk. And then the next day, it sunk even worse. So I'm like, well, this is probably, and I could be wrong. I was like, this is probably a good area to get in, because if it asks this nonsense, which it's showing significant form I'm doing, I would think that's going to keep dropping. To where? I don't know, to this prior down here, or maybe here, so then I would start looking at like areas of supporters, so I would think that this would probably be a pretty good area where it goes up, because we see it bouncing here, and we see it bouncing there, and we see it bouncing there. So yeah, that's why that's in a nutshell why I took that trade. And there's a little bit more to that, and we'll talk about that in correlations. So let me get into correlations, and we should probably wrap this up, because now we're going into an hour and 10, and I could talk all day, but we also are going to do this every single week, so whatever. Here's my goal. It's blatant that selling this thing for $10 a month, that Sean is not getting rich off this thing. This was a service I created out of the frustration I had, seeing that the market that's out there. I look at Facebook, and my Facebook is just plastered. Like, I could go on Facebook right now and see like a dozen people posting up this win rate and that win rate and all this stuff, and all that these guys are doing is they're gathering up their little groups, and then instantly they get 5 or 10 people that are excited about them, and then $200 a month. And what have you. And then they start doing that. But I never see the results thereafter. But people blame themselves. Oh, it must be me. I'm not doing it right. I'm not doing it right. But, I got to pay another $250. This guy really knows his stuff. He's showing me all these pictures. And then these guys then create an affiliate program. Yeah, it costs $200, but if you tell somebody else, you know what, I'll give you $100. So now that person's decided to get the next person in. So what is that guy going to do? He's putting up charts. Oh, look at this. Oh, this win rate and this story and that story. And it's all it is just another pyramid scheme with a price stocks. That's all that. And I got so mad at looking at that, because I saw all these people, good people, hardworking people, and I don't see too many millionaires on Facebook. I don't see too many people with high net worths on Facebook. I would imagine the average income is anywhere between 50 and 100,000, if not even lower. Working people that are just getting taken advantage of and just getting strung onto the next business. And so I was talking with Steve, and that's where this whole thing birthed. I took I'm a financial planner by trade. I took concepts and strategies that I had, applied it to Forex, found that it worked, and I said, well, I'm not going to give it away. I gave it away. Nobody cared. Nobody cared. So I was like, all right, put a dollar amount on it, $10. So then there you go. So now, this whole thing birthed, and I'm getting paid something for it. But I feel it's a very fair justice of my time. But I'm going to definitely always make more out of the market than I am ever going to achieve out of this. So my goal for all of you guys is to learn how to be better traders. And what's going to happen is I'm going to go through everything. I've been trading Forex for 7 years. Knowledge that's just tinkering around in my head, and some things work and some things don't work, but that's for me. Again, there's a science to this business, but there's very much art, and you have to become your own artist in this game. And when you develop that art form, you're going to find something that I'm going to say that's going to resonate. You are going to inherently develop your own methodology, not a trading system, but a methodology. Trading systems try to dictate and determine market movement. Hey, this has to do this, this has to do this has to do that. Here's the number one answer every time you tell us the market's going to do something, the market is going to say bullshit. Because the market's always going to do what the market's going to end up doing anyways, regardless of what you think about it, regardless of these indicators. I saw somebody posted the other day, like, hey, I took this trade, but it went wrong. Why did it go wrong? And every indicator was like this, or that indicator was like that, or this did this, or that did that. I'm like, it's all bullshit. The market did what the market did because the market's going to do what the market's going to do. You're going to lose. You're going to lose point, and so many times it's going to come up heads, and so many times it's going to come up tails. So you could take that perfect trade, but you could even take the worst probability setup, and you're still going to win some of the time. So you could do everything wrong and still win sometimes. You could do everything right and still lose sometimes. So you want to find the balance in between, where, that if you are going to time, again, like I do, 60% of my trades lose, so 40% of the time I'm going to be right. I'm going to be really, 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 really right. And now this right now, as you guys have seen over the last 2 weeks of the portfolio, you see how that comes into fruition. You get in some trades. Some of these trades fall off pretty early, and the ones that stick around, they're the ones that do. So I think we're in a yen trade. I'll pull it up, and we'll talk about correlation. I wanted to show you Fibonacci real quick, and then we'll talk about correlation. And then I promise we're going to wrap this up. If you guys got to go, go. I'm not going to be offended by this. But Fibonacci, my favorite tool. Here's the background of Fibonacci. Fibonacci was a real dude. This guy is like ancient. He's like this 15th century philosopher, mathematician, or some jazz like that, right? Leonardo Fibonacci. And what he discovered something incredible. He discovered that a numerical pattern that is consistent throughout the entire universe. It's crazy. It was a numerical pattern, and I'll explain the numerical pattern. I'll give you concepts to think about, right? The sequence is 0 plus 1. The next number is 1. So you always take the preceding and add it. So 0, 1, 1, 2. So what's 1 plus 2 is 3. What's 3 plus 2 is 5. What's 5 plus 3 is 8. What's 8, 5 is 13. And it keeps going, 24 and 33. And going. And he found that sequence is like a hummingbird's wings beat to that sequence. A sunflower, when you look at the seeds that are growing around it, follows the Fibonacci sequence. The tip of your finger to your elbow follows a Fibonacci sequence. The universe, when you look at our galaxy and how it swirls, that follows a Fibonacci. So it's like this. It almost seems like magic, right? But it's just the whether you call it the miracle of the universe or what have you, God or science or what have you. It's an amazing thing that is consecutive throughout everything. A spit hop follows a Fibonacci. It's amazing. So of course, then traders were like, well, let's apply this to the Forex world. How can we profit off of this equation? And just like anything else in the market, it's a good indicator, but it doesn't work all the time. But it's pretty cool when it does. Okay, so I'm going to show you a good example of Fibonacci sequence. So what you do is you draw from the top, you follow in the drawing of the trend. All right, so we're up here, and we go down here. These are different Fibonacci lines. There's a very important Fibonacci ratio, the Fibonacci ratio called the golden ratio, and that's the 61.8 line. This technical. These guys are getting on the 61.8 Fibonacci line, and that's on here. That's I want to say it's this line, but that's the 50 mark. Yeah, this would be like the 61.8 right there. This would be the golden ratio, and this is like 77.3 or something like that, and then that's 100 and 0. So what happened here? So you drew your mark, right? And look at it. It's like magic, right? It's like magic. It bounced up here, and it dropped, and it just kept tumbling. And some people then, what they do, and this is if you ever want to be a Fibonacci trader, this is a really good rule of thumb. Look for the reversal around here, and then take, and then so you would see that there's some resistance here. So you draw your line, you wait for profit to come up here. You wouldn't just, me personally, I just wouldn't take the trade, but some people just would take it when it hits that, and then set your stop loss here, and take profit here, and you would probably make money. You'd probably, if you stuck to it 100%, you would probably make money. And here's why. When you look at the distance here to here, think of that distance from here to here. I mean, that's probably like 8-to-1 ratio. Here to here, there to there. That's probably a good amount of money. So you could take that trade, and even if you were 30% right, you would probably still win money. But the problem is everybody always focuses on win rate. That's the number one question we get is, what's your win rate? What's your win rate? What's your win rate? And I'm always like, it doesn't matter what I'm making. Look what this portfolio is actually doing. So when you're developing your own methodology or your strategy around it, forget about win rate. Look at probabilities, look at your take profit, look at your stop loss, and if your take profit greatly exceeds your stop oh no. I think I got the boot. All right, I'm back. I got booted there. I'm sorry. I think I'm the only one that got booted. Okay. That's good. I got scared for a second. I thought everybody got kicked out of here. Okay. So let me go back to sharing the desktop. Okay. So Fibonacci. So that's Fibonacci in a nutshell. You could play with that everywhere. So let's look at it. Let's go to a different pair and look at it. So that could potentially make you some money, right? You have your horizontal line, right? So here we're looking at this. We have that, right? Add another horizontal line, right? So you have your area of support and resistance. You have your trend lines. Now we could draw a trend line like that, right? And some people create a channel of a trend line where they want to look at both the top and the bottom, right? Oh, where are we going? Oh, what's happening there? Stop it. All right. I changed the color. I don't know what I did. I'm changing colors. So come on, no? Come on, trend line. Nice to me. I want to change colors. I want to draw. Okay. Great, like channels, right? On trend lines. Trend lines, Fibonacci, vertical lines, horizontal lines, none of those are indicators. Because indicators are always calculating something that the market did in hopes that you then try to predict what it's going to do. You can't. It doesn't work that way. Fibonacci, trend lines, stop and resistance, that's the art. You have to get the art of this business. So you have to open your mind. You have to, and it's very hard because we're in a structured world, right? Where there's rules to everything, you know. But here you can't control this thing, you know. You can't control it. It's just this big whiny cryy baby, and so you just do your best to just make do with this orange monster that we're dealing with all the time, that hopefully we can just pull something back, you know, out of it and get some type of gratitude, or in this particular case, profit, right? So we have trend line, we have that, we have Fibonacci. So your chart, you know, to me this starts getting cluttered, but you could then, again, try to monopolize on this. And then we could even add Fibonacci in here. So let's pull that up and get a little Fibonacci retracement. I bet you any money. Yeah, there we go. So we match it down there. Ooh, come on. There we go. And then, so what's happening? So remember that golden ratio I talked about? All right? So price dropped, hit there, and this is a resistance point here too, right? So this is what's called this is what's called correlation. So anytime you're doing anything in the market, you don't want a single decision. You know, you don't want to just look at Fibonacci and be like, all right, Fibonacci, I'm all in. Bounce off a trend line, I'm all in. You want to look at, like, anytime you are looking at price and you're trying to make a decision, you want like 2, maybe 3, but at least 2 different reasons as to why you're making that call. Why you're going in and making the decision on that trade. Just increase, because sometimes the market is self-fulfilling. Meaning we can create the market, right? It's like if we create it. If we all say, if we all collectively put our money in and we dump $1 billion into one decision, we're moving the market. We're moving. And actually, that's what it's very illegal to attempt to do that if you're a regulated bank. And about 2 months ago, 5 banks paid significant fines because their traders were trading currency, and they were talking to each other on like Skype. They're like, "Hey, dude, I'm getting ready to trade. I'm going to short the dollar here by 100 lots. What are you going to do?" "Oh, yeah, I'm going to do the same." "Well, let's do it at 8 o'clock." Specific times, and then they found out, and then boom, these guys got these big banks. They got fined on that. But nonetheless, I can't remember what I was talking about. So okay, let's go back here. So correlation, that's right. So price went up. You might have already then had you probably wouldn't have Fibonacci drawn at the point, but it doesn't matter. It came down here anyways. You see it goes up. It's hitting that point. And then where would your take profit be all the way down here? So again, there's your stop profit. That's probably easily 5 to 6 to 1. But then along the way, this is where I'm talking about. You always want to let your trades have room to breathe. So this is that, to your point. Do I think something's going to turn around, right? So let's say, for instance, that it's always great when you're looking at things on a macro level, you know, because you're like, wow, we made all these pips. But all these pips, these are individual days. This is weeks. I mean, this is like December 26th, or I'm sorry, January 26th. This trade, you would have entered in November 28th. That's 2 months. So imagine we got in there, right? And we're like, you know what? Balls to the walls. We're gonna get out here, right? A month later. So here we got in. What day is this? November 28th. It's like a week before Christmas, and you're like, just traded and didn't do nothing. Sean, we could have been in the money. But no, Sean, you wanted away. You wanted our loss way up here. But what's happened? You always want to let the market, you always want to leave the market room to breathe. So if a trade's going against you, that doesn't mean it's a waste. It means there's variance. There's other elements that are going around, but if it got to the point where it went past that, then most definitely we're getting out. Some people are even at, but no, watch this, Fibonacci, right? So Fibonacci, and then now this inherently became its own resistance point, right? And then it struggles again over here. This is like the 164 line, I believe, and this is like 217. I might be off on these numbers, but I'm probably pretty right. So some people even have this at that. Another way to trade is to take profit along the way. Okay, so we have a trade here. We entered in here. We had a take profit here. We had this as our stop loss, or I'm sorry, our stop loss here and our take profit here, right? We could say, you know what? Let's when we get here, let's just even out. Let's just go even. It went down enough. We'll move our stop loss. It's called a risk-free trade. So no matter what happens, if the market goes against us, you know what? We're okay. Hey, we had a good shot. The trend, it didn't do what we didn't do, but we certainly didn't lose either. And what would have happened? And you would have broken even on that trade. Okay. Another way you could do that is you could say, you know what? It came down here. I want to move my stop loss, but I kind of want to get paid. So you might close out part of your position. So you might in a nice way to judge some of your position is by buying in the opposite direction. So if you're 100,000 units short and you just buy 25,000 units, it instantly closes. It pulls out 25,000 units in the U.S. because it's illegal now to hedge. Some people would have two different directions at the same time, which was pretty sweet. Because then you could, and I was around for that time. It was pretty awesome because then you could really take the entire trade. So, like an example of that would be, just want this to come down here, but along the way, it hit a resistance point, and we were like, it's probably not going to get past that again. You could then take a trade in the opposite direction, profit on that trade, while you're still in the short and still going to profit on the trade. Pretty sweet. But again, it was people would abuse it. People were being stupid with it, and they're over-leveraged with it. So they'd be over-leveraged in two directions. And, the government bodies are like, enough of this crap. You guys are stupid with your money. And every time people are being stupid, we're going to put a law around it, So we can't do that now anymore. But what you can do is you can then just buy out of your position. So you can buy out of the position, and then that way you have some profit. And then you move to the break-even point, so you move your stop loss to where you came into the market. So that way if it goes against you, then you still came out ahead a little bit. You still made some money. Or you could say, there's no right or wrong to this. The idea is no matter what you decide to do, whatever your trading plan is or whatever strategy that you adopt, sure that you're making more than you're losing. That's it. That's it. You always want to make sure you're making more than what you're losing. Another way you could do this is, let's say we wanted to go up, all the way out down to there. We could say, okay, it got to our 161 line. Let's take out half. Move it to break even, because even if we pull out half, our take profit is so far ahead of what our stop loss was that even we're always going to get the money by doing it every single time. So even if our trade went against us, hey, you know what, we didn't make all this money. We made half of what we could have made. But what happens if the price keeps going down lower? So then you could say, let's have my second take profit there. So then you would have your second profit there, and you would close it out. How you would set that up in Oanda is you would create then a limit order. Okay, so if we what am I from Boston? So if we purchased here going down, right? If we put in at that point, and we were like, you know what, we really, 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 really want to go here, and we're going to set this as our take profit. We could put a limit order for half that direction. So if we sold 100,000 here, we could put in a buy order there for 50,000 and still have original take profit there. So as that continue to plummet, we could then pull out half. You would have to then manually on your own move the stop loss, but then it'll continue to tumble down to where then again you could have made double on that second half, but you still you still did pretty good. Now I don't do any of that stuff. I've been doing this long enough that, like, all that creativity is out of me. Like, I used to do all these things, you know, and I just, and maybe sometimes I won a lot, sometimes I won a little, but it was just more work for me. Like me, here's what I want. This is the most activity I've had in sports in a while, and that's only because I'm like teaching and training people how to do this now. You know, but before all this, here's what I did. Every single day, I'd wake up at 11 o'clock, and I'd look at my charts for 15 to 20 minutes, make some trades, go to sleep, wake up in the morning, see how they're doing, and then sometimes I wouldn't even do that. I was just getting the routine that I would only when I was making my trades, because I know my win rate. I know I'm profitable. I don't need to be glued to the chart. I don't need like 6 computer screens and taking Facebook photos in front of rented Porsches, zines, and all this Forex sites that people are all hashtagging, all this ridiculous crap. I prefer boring. I prefer very, very boring and profitable, because I don't care what you say. I have 2 children that are 6 years old. Playing with them, like the Wii with them, is way more fun about bumping down. I mean, it's way more fun. You know, I went to see Paddington yesterday. You know, and all the people that are like short-term traders, they're just constantly glued to chart because it's weird, because you're trying to create this home business and doing your own thing, but you just transferred your time from one thing to another. And in me, that ain't me. You know, I'm all about like spending time. At the end of when I'm 120 years old, that's when I'm going to die. 120 years old. I'm 120 years old, and I got my great grandchildren and my grandchildren and my children. You know, my niece, everybody else surrounding me. You know, there's not at any point in my life where I'm going to ever say, man, I wish I, would have made one trade. You know, I wish I would have had one more computer screen. For me, it's the value that you take in life. So when you're coming into these ventures, you want to look for opportunities. And here's something standard in life. This is how I live, right? This is how I live right now. You always want to look for things that you can do to leverage your time. You know, whatever it is that you can do to leverage. I have a practice, I have a financial services practice, and I have staff. I have people that just do things for me. I delegate that stuff to them. And could I do it on my own? Yeah, but do I want to? Do I want to do that? I'd rather do something that's more Forex. I look at Forex like this is a really good opportunity for me to spend a little bit of time on something and have a really good return. I get to pick and choose my calendar every single day, and that everybody has that opportunity, but everybody can. You have so anytime you're looking at anything in life, look for something that can give you the most time for yourself and the most leverage. Like this site. I could do this on my own, right? I mean, I could just pay somebody to put up a service and all, but I don't. I partner with people that have talents that I don't have, and put into my profit, but now I'm sharing that with somebody. Now I'm solidifying something new. Now I'm giving something, giving away a service to all of you guys to be able to, really take advantage of it, so you can have your. So keep that in mind with all your ventures. And I'm off my stocks on that, but that's a big motivating factor of why I do Forex, and I think why we do any of this. And all you people, we're all networked together for the one common goal of trying to make some money, right? And it ain't for the pile of cash, right? It's for the lifestyle, all that other good stuff. I was on Oanda, and I can't remember because I got on some stupid tangent. Here, magnetic trend lines. I think the magnetic trend lines are unique. That's Fibonacci average. We don't have to worry about that. What was I going to show? Oh, I was going to show you correlation. We'll show you correlation, and then we should really wrap this up, because now we're going on 2 hours. And I really like you guys and all, but we got stuff to do. Okay, so Send always, I'm trusting you guys can still see this screen. Let's internet. There we go. All right, so log in. Everybody tell Steve how awesome he is. He created all. This is all a tech guy. He's all of this. I missed your question, Judy. When do you move your Fibonacci line straight? That's the science of it. Anytime you see a high, you always want to put your Fibonacci mark at the high and the low. So there's no when I move it. It's when I see a new low or I see a new high. I'll redo a Fibonacci. But I don't even have to. That's my point. Is I don't even have to draw it anymore. I just see it. I just see what's there. That it's probably the golden ratio. Okay, let me log in here. What's my okie doke. I think I have an account. I think I have an account. Steve. Again. Well, what's the business? I'm trying to pull up. Okay, you guys probably have a better advantage of this. Go into your the back office login. I'll talk you through my on the MetaTrader, right? So I'll give you guys a minute, and we'll wrap up on this because this is really getting long and silly now. But this is correlation of the market. So this can help you better define decisions that you're making. This is really the big power behind portfolio-based trading. Because when you find correlations that are moving together, you could capitalize on that, and it can thwart you from making bad decisions, right? Okay, so if we all have it, I'm going to say this. Right now we have 4 open trades. Okay, we have the Aussie lean, right? So that's the AUD CAD. We have the Aussie dollar, right? We have the pound Aussie dollar. We have the pound New Zealand dollar, right? So we have those 4. Okay. Again, this is going back to the currency 101. One pair is versus another. So we have what? We have the Aussie versus another pair, right? Aussie versus another pair. We have the pound versus another pair. Now, it's on there that where we see the Aussie dollar, right? Right, we see it in those 3 trades. We see it against the dollar, the Canadian dollar, U.S. dollar, and we see it against the pound. But notice the placing of it, right? Notice the placing of it. You see how the Aussie dollar on one end is on the opposite end of the other, right? So the U.S. dollar is in the opposite trade of the pound Aussie dollar or whatever the hell they want to call it down there. But notice that the trades are different, right? So one, it's essentially both selling it. I'm selling the Aussie dollar on both sides. Because I'm selling the Aussie dollar against the U.S. dollar, and I'm buying the pound against the Aussie dollar. So that's a correlation. So that's telling me if I'm getting signals, if I'm getting price action that's moving in one direction, maybe let's look at some other correlated pairs and see what they're doing. And there you go. Well, they're moving together. They're moving in sync, right? Now look at the pound New Zealand dollar. All right, those are both then moving in the same direction. I'm buying. So right now the pound is just gaining strength against other currencies out there. You know why? I don't care. It is. I'm looking at price action. The fundamentals rate is only 20% of this thing. So I'm waiting. Talking about before really, before I take pay mind to it. So when I'm making decisions, right? So like the other day, I saw the pound dollar. I saw an opportunity to sell the pound dollar. It looks good. So but let me take a look around. And then that's just where I looked at the equation. And I saw that there's too much strength going against that decision that I was just uncertain of the direction. It's just like I'm not, as I do place those trades, not with the intention of losing it, but if I really think that one's at the end of its rope, I might get in on something where it's negatively correlated with the idea that one might stop and then the other one might predict anything. Where I am, I'm just in the back office looking at the open trades. Yeah, that's just what. I'm looking at all the. I don't know how long to hold that question. I just saw that now, but I'm looking at the open trades that we have, and I'm just talking relation. So if we go back over here, let me show you that. And I closed it, didn't I? Oh, I'm so stupid. Let me why would I do something like that? And then we're really wrapping this up. All right. Oh wait, hold on. And this is like more of an advanced way of looking at. I mean, I don't prefer my decisions. I think it's pretty smart. And that's what it's doing. Then is usually when we're winning well, it's a bunch of trades that are all pushing in the same direction. And so that's why I had a reasonable. That's why I was comfortable making the decision on against us. I was still comfortable with it because I'm like, hey, I'm already selling the dollar aspect. Let me try it in the other. I think it's still going in there. And we'll see. We'll see in a couple of days. And 60% of the time, I'm going to be dead wrong on that. But times I'm wrong. So okay. So let's first look at the pound New Zealand dollar. All right. Oh, that's 15 minutes. Look at this thing. Look how beautiful this was. Okay, now this is where, like Deb was asking me before, like if I thought someone was going to go in the other direction because he's probably over leveraged. It's okay though. She's probably over leveraged on it. We got in on this guy here, right here, and I'm joking with you, Deb. So I don't know how people's feelings are, but being fun here. So this is where we got in, right? And so this thing tanked like bad. I mean, look how close our stop loss was here. So I remember I was talking with Steve, and just in conversation, I was like, yeah, and probably tomorrow this thing's probably going to stop out, and we're looking at this, that, or the other thing. But look what happened. It took a complete turnaround. So, this was a Friday, Saturday, Sunday. And then Monday it's been doing nothing, all these inside bars that I hate. And then it just, broke crazy. So all last week it just started shooting up. And then this is our Monday candle. And then, this is the start of the Tuesday candle. Mine looks a little different, but it's all fundamentally the same for the most part, just a variance of a couple hours. But this is a great example of, I got in here. because I think my decision really was just because I usually make simple decisions. Well, I guess it wasn't so simple. I saw here and I'm like, oh, that bounced a lot. Like that bounced a lot. So if it went here and went there and went there, it's probably going to do the same thing. So I didn't take the trade at that line, right? So let's try that line. Yeah, I make these decisions so quick that I don't even really remember the exact decision I made when I made it. But we'll put that line there. All right. So I didn't. Let me see if you guys go. Okay. I didn't make that decision when it hit that. Right. I got in here. So what did I do? I waited for it to it. So every candle tells a story, right? Right. That's what we're talking about. So I saw one here, and it couldn't. It broke through. But here was the big thing for me, that it had an opportunity. It broke through this resistance, and it just couldn't get it. So I saw a struggle, right? So for me, I was like, okay, we're going to find out what's going to happen on Monday, right? So the Monday, what's going to happen? Is it going to go up? Is it going to go down? And whatever direction it's going to go into, I'm going to take a weekend to think about it, get all their orders ready, and then Monday everybody is going in, and they're going to do whatever the heck they're going to do. So I waited till the end of Monday. So all these people, they got in, and they probably just got out at that high or whatever. Who knows? I got in there, and then bam, it tanked, and our results our unrealized profit, what I think was partially negative, like the first time in like 2 months, and some crap like that. And then boom, this thing kept going. And I think I don't have a take profit on it yet. I'm hoping that it's going to get to about there, where it's gonna just rise all the way up there. So I mean, I'm still not going to put a take profit on it just yet. I could change my mind if it comes over here and it starts doing some funny stuff. But you know what? That's kind of looking. That kind of looks good, and price could, it could. I'm not saying it will, but it could get there. I mean, right now, if we look at Fibonacci, right? There's a million different ways to look at the market. But if we look at Fibonacci, oh man, Fibonacci's going to tell me to take profit now, isn't it? I'm not going to, though. I don't want to yet. Because I'm going to let price determine some fib. Look at you, Fibonacci. All right, so that's good old Fibonacci, right? So the golden ratio, yeah? Okay. So we drew it from the top. Golden ratio. I didn't even draw a fib on this. I don't know why I did. I don't even mentally look at it. I think I was really just looking at that bottom resistance point. But either way, Fibonacci still is showing us, like, look, it's bouncing here, and this actually correlates. This golden ratio, man, it's amazing how the market just does its thing. You can almost draw another line right there. Amazing, the correlations of the market. This golden ratio, this hadn't even formed yet. It hadn't even formed. And yet this golden ratio matched up with this stop resistance. Still, look what happened. Price struggled there. All right? And thankfully for us, it kept going. But if it would have kept hovering around there, like if it would have got all cluttered like this or like this, I would have probably just said, all right, let's get the hell out. We took our money. And we're happy. But now I think this trades up like 750%. If it gets up, I think a recorded record. I've had over 1,000 pip trades before, but I think this would be like a 900-some pip trade. That'd be our record. And if it gets up here, this would be so. There's good profit to be made. And what's fun about that is if you want to like brag to somebody, you can always brag about, hey, well, have you ever closed a 1,000 pip trade? But the thing is, they're always going to trump us about how much money did you make. And 1,000 pip trades probably like a 12% gain, which don't give you could put your money in the stock market for a year and get 12%, like a year. All last year, the market jumped up like 19% or something as a whole, which is good, which is very good for our economy recovering. But like for us to do that in a month, what it took something like doing a year for safe money, that's pretty incredible. So that's where we're at. So that's just a good concept of how I'm trading. So here's what you could. you guys do whatever the hell you want to do. Are just my signals. It's the whole concept of this is earn as you learn. As you're learning, as you're developing and devising your own strategy and trading platform, you're able to make money. And for some people, they want to be traders, want to do this on their own. Go ahead and take advantage of this and work. Other people, they want to be passive and they just want to take trades and profit. There's no right or wrong because all of our different goals are the same. But I'm going to go and wrap this up. I want to thank everybody that brought people on board. So the best way to thank is by giving things away, right? So if anybody had brought a guest in tonight and they enjoyed what they heard and they learned, they saw, and if for them it's worth $10. If they decide to sign up under your affiliate code, if they're not affiliate, it's free to sign up. And if you invite them in, we'll give them a month of SMS service for free as well as you. So whoever invited them, they're going to get free text messaging service for a month, and then you're going to get as well. So, hey, it's not a lot of money, but, hey, I think we're like negative. we're giving things away at this point. So, is there any questions that we have before we get going here? Well, you can type it in if you guys have questions. And I'll wait here a couple minutes. And if there's nothing, then we can just wrap it up. If you guys don't have anything, this really kind of concludes it. So feel free to check out if you want. Just exit, and then we'll see you guys next week. If you guys do have something, you can hang around and chat with me a little bit, and I'll answer any questions that you guys have. But again, I appreciate you listening to me for 2 hours. I got so much to learn, and I'm excited to teach you guys to start making a lot of money here collectively, going group $10 signal cruises or something. How long? I got a text question here. Hold on a second. I've been trading stocks and bonds for actively with real money for probably over a decade, probably like since the days when I was in the military. I would paper trade before then, so I was like 12 years old. We had the Journal Sentinel here in Milwaukee. It was the business section. I was just in trade. And I would buy like tech instruments. I always had this little thing as a kid where it's these weird stories that you just grow up to be what you want to be. Where I figured that if I liked it, I'd buy it. So in Texas Instruments, so it doesn't matter. But so I've been trading actively stocks and bonds for about 15 years. I've been trading Forex specifically for going on 8 years. I started in 2007 when I don't know. I'm trying to remember how I got introduced to it. I was introduced to it on a Friday. I remember somebody mentioned something about making money. This guy was like, "Oh man, I made some money," and I'm like, "Well, how?" He's like, "It's a beast," but and he gave me a link to. So I don't remember what it was, and it directed. So I went to babyfits.com, and babyfits.com had a school, and I remember, and it's a very good, if you want to learn Forex in a nutshell, just in a nutshell, just to get an idea of it, not really teach you how to do stuff, just to get your mind around it. They have a very good educational school to just make you feel like you're dangerous. And I remember I took off for work for like 2 days and read it. I just stayed at home and I went through. I just kept soaking it in, and then I have crazy disease where I have to keep learning. I have the most useless knowledge in my head because for some people when they come across something, they're like, "Oh, I don't know why." I mean, I don't know what is an acceptable answer. I have to. That's like if I had any good OCD in my life, that's the one with good OCD. So I kept reading, and I read everything I could. I scoured websites for hours, and I spent an extreme amount of time learning this. I mean, I'm still learning. You're always learning, and I'm at a point. I would think about probably about 3 years ago, where I just was comfortable, like doing just trading where I didn't have to that I really scaled back, and I just took my time with it, and I wasn't push trades, and I wasn't, because like everybody else, I wanted to make $1 bazillion, and I realized that just isn't feasible. And then when it was coupled with, I became a financial planner, and I started building my practice. And so I had to learn to be more conservative, because my clients were not as risk taking as I was, and just being in that environment, I eventually approached investments in general. So when I just started applying that towards forex, what I was doing is I was using it to, I was paying my taxes out of my forex account, or I was dumping money into it. As a holding, I would hold 20% of my income in there and trade it, and then at the end of the year, I'd withdraw it by taxes, and then I had my, take a trip. I'm doing it again this year. We're going to Mexico and all that other good stuff. But yeah, that's how long I've been doing this. Told you I was long-winded. Any other questions? I don't know if I'm getting the questions popping, but I'm gonna get rolling on this thing. If you can hit me up on Facebook if you'd like. Message me is probably the best way. If you were gonna try to communicate with me in the Facebook, make sure you tag me, because then I get notified of that, so then I can address you a lot more quicker. 80% of my life I have some type of, I respond pretty well, pretty good at multitasking. So yeah, so we'll wrap it up. So I appreciate you guys. Hopefully we can give away some free stuff. And then we'll continue to grow and invite more people. It's $10. I guarantee what you learned today. There's people that charge you an exorbitant amount of money for what you just learned for free. For those that are members, obviously, then you're $10 out of that. So we'll see you next week, guys. All right, take care. Bye.